Two American workers entered the same recession with identical savings, but their portfolios told completely different stories. One trusted the stock market completely, while the other quietly spread money across four very different assets. Then the financial system began breaking, and suddenly, diversification meant something much more complicated than owning many stocks. Because when markets crash, different assets do not respond to the same economic forces in the same way, and that single idea could completely change how you think about protecting your money during the next crisis. Meet Jake, a fictional Ohio worker who believed simple investing meant owning one broad stock market index. Jake had $100,000 invested, and everyone around him told him stocks were enough. Across town, Jasmine had roughly the same savings, but her father taught her something completely different. Instead of betting everything on one market, Jasmine divided her money among four economic behaviors. She owned gold miners, long-term government bonds, consumer staples, and productive farmland exposure. Then came 2008, one of the most violent financial crises America had experienced in generations. Jake watched his stock portfolio collapse as banks failed, credit froze, and investors desperately searched for safety. The S&P 500 finished 2008 down roughly 37%, a brutal decline for ordinary investors. But here is where the story gets interesting, because Jasmine's portfolio did not behave like one giant stock. One part rose, one barely moved, one fell, and another quietly behaved according to completely different economics. That is the first lesson. Diversification is not just owning different names, it is owning different reactions. And before we examine those four assets, we need to understand why crashes themselves are different. A banking collapse is not the same problem as a pandemic panic or an inflation shock. The first crisis type is a credit crisis, where debt problems spread through banks and financial institutions. The second is a liquidity panic, where investors sell almost anything simply because they suddenly need cash. The third is an inflation shock, where rising prices force central banks to raise interest rates aggressively. And that difference determines which assets become helpful, useless, or surprisingly painful. Start with the asset people most often misunderstand: gold mining stocks. The popular story sounds simple. Gold protects you when stocks crash, so gold miners must protect you too. But a gold mining company is still a company, with employees, costs, debt, equipment, and shareholders. During a panic, investors may sell mining stocks simply because they are liquid and easy to trade. That means the stock can fall even while the underlying metal looks relatively strong. That is exactly why gold miners suffered heavily during the financial crisis of 2008. The VanEck Gold Miners ETF, GDX, lost roughly 26% during calendar year 2008. So gold miners were better than the broad market that year, but they absolutely were not crash-proof. And here comes the twist. Their real strength can appear after the panic instead of during it. Once forced selling fades, investors can return to gold exposure and mining companies can move sharply. That makes gold miners more interesting as a potential recovery asset than as an emergency crash shield. Then 2020 delivered another warning, because the pandemic panic caused nearly everything liquid to be sold. The lesson was uncomfortable. Even an asset design. So if someone tells you gold miners always rise when stocks fall, remember this distinction. Gold exposure and gold mining stocks are related, but they are not the same financial instrument. Now consider the opposite character in this story. Long-term U.S. government bonds. For decades, Treasuries gained a reputation as the boring asset investors wanted during financial disasters, and 2008 gave that reputation one of its strongest historical examples. As stocks collapsed, investors rushed toward highly liquid U.S. government debt, seeking relative safety. When demand for existing bonds rises, their market prices can rise too, helping bondholders. A long-duration Treasury ETF, such as TLT, gained roughly 34% during 2008. That is a genuine hedge, but only if the economic environment cooperates, because bonds have a hidden vulnerability that becomes obvious when interest rates start moving upward. When newly issued bonds offer higher yields, older, low-yield bonds generally become less attractive. That relationship became painfully important during the inflation shock of 2022. The Federal Reserve raised rates aggressively as inflation surged. creating enormous pressure on long-duration bonds. TLT finished 2022 down roughly 31%, turning the old safe haven into a major loser. So the asset that helped dramatically in 2008 became one of the worst performers in 2022. That is not a contradiction. It is exactly how economic mechanisms work. Now meet the least exciting asset in this entire story. Consumer staples. These are companies selling things households keep buying even when confidence collapses. People may delay a new car, but they still need food, cleaning products, and basic household supplies. That predictable demand can make these companies more resilient when economically sensitive businesses suffer. In 2008, consumer staples were among the stronger sectors, even though the broad market fell sharply. The important part was not that staples magically rose, they simply tended to fall less. That difference becomes incredibly valuable when your goal is survival rather than spectacular performance. And unlike gold miners, staples do not need a gold price rebound to justify their business. Unlike long bonds, their core demand is not directly dependent on falling interest rates. That does not make staples risk-free. It simply gives them a different source of resilience. Then there is the strangest asset of the four. Farmland. Farmland does not trade every second on an exchange like stocks, bonds, or mining companies. Its value is connected to productive land, crop economics, rents, financing conditions, and local supply. That creates a return stream that can behave differently from daily Wall Street sentiment. During market panics, physical land does not suddenly become worthless because stock prices fall. People still need food, farmers still need productive acreage, and land can continue generating economic output. But farmland has one enormous weakness that the other assets do not: liquidity. You cannot normally sell a farm this afternoon simply because markets suddenly look dangerous. Public farmland REITs can offer easier access, but their shares still trade like financial securities. So investors should never confuse a publicly traded farmland company with owning a private field directly. Now we can finally compare all four assets across the three crisis environments. In 2008, the dominant problem was credit stress, collapsing housing markets, failing institutions, and fear. That environment favored assets investors perceived as safer and more liquid, especially high-quality government bonds. Consumer staples also showed resilience because households still needed basic products. Gold miners fell substantially, reminding us that mining companies remain equities during a liquidity crisis. Farmland behaved differently because physical land was not repriced every second by panicked traders. Then came 2020, when the problem was different: speed, uncertainty, and an enormous demand for cash. In that environment, even assets normally considered defensive could briefly experience violent selling. That episode taught investors that liquidity itself can become more important than valuation during a sudden panic. And finally, 2022 introduced the opposite enemy: inflation and rapidly rising interest rates. This time, long-duration treasuries were hurt precisely because rates were moving upward. Consumer staples remained comparatively defensive because people still needed everyday products despite economic uncertainty. Farmland had a different relationship with inflation because agricultural income and land economics can respond to food prices. Gold miners were somewhere between, sensitive to gold prices but still exposed to company costs and equity market sentiment. Now notice the pattern. No single asset won every crisis, and none was perfectly defensive. That means building a portfolio around one remembered crisis can be dangerously misleading. If you prepare only for 2008, you might build exactly the wrong protection for another inflation shock. If you prepare only for 2022, you might ignore assets that could help during another credit collapse. The goal is not predicting the next disaster perfectly. The goal is avoiding one fragile assumption. That assumption is believing one investment must protect you against every possible economic environment. A better approach is understanding what each holding is supposed to accomplish before the crisis arrives. Treasuries can offer defense in some deflationary shocks, but rising rates can hurt long-duration bonds severely. Gold miners can offer leveraged gold exposure, but their shares can fall sharply during forced selling. Consumer staples can provide defensive equity exposure because their products remain necessary through many economic conditions. Farmland can provide exposure to productive real assets, but access, liquidity, and valuation require careful consideration. The real advantage comes from knowing why you own something, not simply hoping it saves you, because the next crisis will probably look different from the last one you remember. The smartest portfolio is not the one that predicts tomorrow. It is the one that survives uncertainty.
Know the economic weather, understand your assets, and build a portfolio designed for uncertainty, not a single perfect prediction.